Well, good morning, everybody. The mic on, wonderful. I want to expand on Tom's idea that speed is related to the amount of information that we can process for business-making decisions, because indeed, the universe is exploding with information. This is not from the Hubble telescope. This is actually a physical rendering of the World Wide Web, and we're right about here in the southeast of the United States. And it wasn't long ago that 32,000 bytes of information on a PC was a significant amount. Right now, we've got voice information coming at us. Skype claims they can handle 20 million users at peak times. We've got social networking information. This slide's already obsolete. It's up to 500,000 users on Facebook. Thomson Reuters records and archives 750,000 price changes in the markets every second for 10 billion a day. And the world generates 15 petabytes of information. And those companies and the law firms that are prepared to take advantage of all that data are building out an infrastructure to handle that. And nobody does that. Wouldn't be an innovation forum if we didn't mention Google, who, it's reported, has an addressable storage capability of 100 exabytes. And to put that into context, all the information in the world, there's only 800 exabytes. And so if you're like me, you have to go to the dictionary to find out, well, the heck's an exabyte? 18 zeros, 2 times 10 to the 18 bytes of information. More people are sending us information. We do a lot of survey work with professionals. And we know that in the last 4 years, the amount of professionals that have more than 50 emails a day has doubled. Those evil Santas that Tom talked about. And we know from our product managers at Contact Networks that the amount of contacts per person on that platform has doubled from 2007 to 2009. We're getting more information from more sources. The amount of professionals that are using email, phone, fax, and newspapers, that stays the same, but now we're adding instant messaging, social networking, blogs, and video. And of course, we're spending more time consuming this information. The amount of professionals who spend more than 3 hours a day reading the newspapers and journals has increased 60% in the last 4 years. The amount of people who are reading more than 3 publications a day has increased 85%. For MBA students, it's even more. They're more used to consuming that type of information. So we are overwhelmed with information. It's just not, as one of our survey participants put it, there's a tsunami of information coming at us. And so as information providers, we're extremely interested in how people make decisions under these stressful circumstances. So I'd like to offer a model on decision making, a continuum between intuitive-based decision making and analytical-based decision making. Now, intuitive-based decision making we found out from Malcolm Gladwell, who famously wrote Blink, the book about not thinking, or the power of not thinking. He describes phenomena like thin slicing, the ability to take small bits of information about the world, use your latent knowledge, and then project into your decision-making capabilities. And it's great for quick and fast decisions. But there's some pitfalls. Tom mentions behavioral psychologists, behavioral economists. They've come up with literally scores of psychological biases that we have as a part of our makeup. There's biases like the confirmation bias. The idea, the propensity for us to only seek out information that confirms our hypotheses. There's the overconfidence bias. I don't know if that's relevant for anybody in this room. Certainly you don't have overconfidence, and nobody that you work with in those law firms suffers from this overconfidence bias. Actually quite confident in that. But the biggest pitfall to intuitive-based decision-making is that it's unauditable. You can't go back and record why you made a decision and then create a feedback loop to make a better decision the next time a similar type of situation arises. On the other hand, that's not a pitfall for analytical-based decision-making. When you amass a lot of data, you supposedly will record that data, and that's the basis for your decision. But there are some pitfalls with solely using an analytical-based decision model also. One is this idea that not a lot of people know about, but that there are diminishing returns to the amount of information that you can use to make decisions. It actually becomes less and less likely that you'll make a better decision sometimes when you get more information. That's called analysis paralysis. We kind of describe that as the risk of not seeing the forest for the trees. I'm going to go back just a second here. So when professionals are overwhelmed with information, they gravitate towards one extreme or the other, typically on the intuitive side. So we ask ourselves, how much information is needed to optimize that decision making? And actually, that's not the right question. The question is, what's the quality of the information that we need for us and our professionals to make those optimized decisions? Okay? And those qualities are part of what we call the hierarchy of information needs. Apologies to Maslow. Information has to be trusted. Okay? Information has to be contextualized. It's got to be sensitive to the profile context. Who wants the information? It's got to be sensitive to the session context. What does she want the information for? It's got to be sensitive to the data context. What type of data do we have, and how much should we give and know more? The information also has to be connected, especially if it's from disparate sources, so that there's a common thread, there's coherence around that information. And of course, finally, it's got to be channeled properly. It's got to be delivered to the decision maker on a platform or a device that makes it easily consumable. And when we have all those conditions met, we call that at Thomson Reuters intelligent information. It gives you knowledge to act. It is actionable intelligence. So how do we know this? We do a lot of experiments, and I'd like to share one of them with you. We went to the London Business School also, Tom. Is he still in the room? And we went to a bunch of MBA students, and we gave them 30 pounds, split them into 2 groups, and for group 1, we gave them the unintelligent information. It wasn't trusted, wasn't contextualized, wasn't connected, and wasn't channeled properly. And to the people in group 2, we gave them the intelligent information. We told them to do one thing, make a bet, buy or short a stock. Basically, figure out whether this stock's going to go up or down. We threw a little curveball at them to model this idea of diminishing returns to information. We gave them 10 minutes to make this decision, but after 4 minutes, we docked them 2 pounds and gave them some more information whether they wanted it or not. And what do you think we found out? The people in group 2 made decisions better 10% of the time. Now, when I was going over this with my wife, she said, 10%, that's not really a lot. But if you've got a 10% advantage over a bunch of London Business School students, that puts you in a better position than you would be if you didn't have that. And if you're trading with 10% more capability, you're making millions of dollars. And that's actually what happened also with group 2. They were able to not only make better decisions, but they were more profitable decisions. 40% more money was made by the people in group 2 because they were able to arrive at the decision faster. And so they didn't get docked that 2 pounds. And then the interesting thing about the people in group 1 is their decision making was more disparate, more inconsistent. So better decisions, more profitable decisions with more consistency. That's what intelligent information gets you. So in this universe of exploding information and stressed out professionals and bad decision making, to us it's obvious. It's not that you need more information, but you need better information. And who better to talk about what that information might be than Patrick Fuller, who is a managing account director, specializes in competitive and market intelligence. He's going to present some case studies about where this information matters most for us, how to allocate your precious resources in marketing and business development to drive more business for your firm. So take it away.
First of all, I appreciate that. I planned to come up here like Stephen Colbert and kind of run on with my arms up like this. And I saw the video camera, I saw the steps, and I thought, that's a YouTube moment waiting to happen. It's interesting. When Charlie and I found out that we were coming on after Tom Stewart, we sort of talked to each other. We figured that it was a little bit like Milli Vanilli coming on after Bruce Springsteen. So we're going to do our best to try and get through this as quickly as possible. So, one of the themes of the day today is insight. And it's a lot of what we do on a regular basis. We're looking into a situation. We are trying to see the inner nature of things. It's a term I found out through research was actually first used in the 13th century. Interesting. And it's part of this thing called, that gets into insight phenomenology, which I think is really, really sort of interesting. We've done this before. We've looked at a situation many different ways, time and time again. We keep looking for a solution. We keep looking for a solution. We never really see it. Then all of a sudden, like out of the blue, we just stumble on something, and it's like, wow, okay, why didn't I see that before? And you look down here at the analysis, sort of what, where insight is derived, the analysis of a past experience with the purpose of gaining insight for use within this model at a later date, or the analysis of future scenarios. It's a lot about the intelligence world. It's a lot about what a lot of us do on a daily basis. So with that said, we're going to take a step back. I'm shocked that nobody got the Snoop Dogg reference. If we can't work Snoop Dogg into legal, then there's a problem. Back in 2001 was before we had this little economic meltdown of 2008. You guys may have heard a little something about that. Was the last year in legal of real significant margin compression. And so I went back and looked at the financials from 2002, which was the 2003 AmLaw 200, and compared them with this last year's AmLaw 200. And it was interesting. The revenue in 2003, fiscal year 2002, just shy of $50 billion. Not bad. 2010, just shy of $82 billion. 64% growth. Pretty good. During that same period, we saw a 22% increase in total lawyers. So we had a 3-to-1 increase of revenue to total headcount. During the 7-year period, only a 10% increase in equity partners. Revenue per lawyer went up 33%. Profitability went up 51% over 7 years, a little more than 7% a year. To put this into context, the amount of money on average in terms of profitability that happened in 7 years took the previous 16 years for the AmLaw 200 to attain that level of profitability. That's how much this market was rising. Another interesting fact is we had a 550% increase in the number of law firms that made $1 billion a year or more. Went from 2 to 13. And of those two, a couple of them went to $2 billion. And it's, again, another little interesting side note. It took Skadden 51 years to get to $1 billion. It took him 8 years to get to $2 billion after that. So we went back and we looked at, sort of the division of the AmLaw 200. And in 2003, I split them up with the top 50 to 51 to 200. And the percentage of the market that in 2003 that the AmLaw top 50 had was 52%. In 7 years, they tripled that gap. It went from a 4% gap to a 12% gap. Now, I'm the furthest thing from an economist. That's Charlie's job. But we keep seeing price pressure. You guys experience it every day. There's AFAs, more RFPs. There is more pressure on price. We also know that in a lot of cases, a lot of the work going to the AmLaw top 50 is going to be in the capital markets. It's going to be on the M&A side. It's going to be more high-value work. And I think, and I could be wrong, but 5 years from now, we'll be up here again, probably still in Georgia, but up here again. And we'll see that the AmLaw top 50, now it's a 60-40 split, or 62-38. I think that gap is going to continue to grow. So what that means is for a lot of firms now, the ability to act and make decisions in a much smarter, more efficient way, that confluence of effectiveness and efficiency is going to be paramount. Speaking of which, we bring you Peter Drucker quotes. So many of you received a survey from us a couple of weeks ago. We sent out to a number of people, both people that were attending this event and also a number of people throughout the industry. 4 questions. As Lisa Simon told me, it actually took less than a minute, which was really good. We wanted to sort of get an idea of what's changed over the last 18 months. And so we wanted to look at the RFP increase for your firms. You know, not just RFPs, but RFIs, RFEs, you know, anything with an RF in front of it. And so the responses were kind of what we expected. You know, although we didn't expect that much of a decrease from certain firms, 14% said that the volume actually decreased. 21% said it was fairly stable, didn't change. 28%, the largest there, had an increase of 10%. We saw a few with 25%, and then even more had a 50% increase in their RFPs. That's one data set. That's interesting, but it doesn't tell the whole story. The other question we wanted to know is from a complexity standpoint, have they increased? And the answer is not shocking. Both the time it takes to complete them and the level of complexity have gone up tremendously. Oh, and on top of that, a lot of your departments haven't really grown either. So the size is, in some respects, increased, you know, in terms of the departments. 25% of the respondents said that the size of their marketing department did increase. 28% said it decreased. 42, almost 43% said that it didn't change at all. So 70 some odd, roughly 71%, they're the same or lower, yet the demand on their departments, as we see from the next data set, has increased almost 68%. As Charlie talked about information overload, there's also demand overload. The one thing that I did ask that I found is changing, and there's a little bit more transparency now. Almost 86% of the respondents, you know, we asked if they had access to financial software, benchmarking software, things like Redwood, things like Pure Monitor, some of the other, you know, Elite BI, some of the other types of tools, not just pure company financials, and 86% said yes. And that's important because what we're going to talk about is how to leverage a lot of this information from the financial side with the market information as well to yield better results. This is another one of those quotes I think is outstanding. Albert Sangiorgi, who discovered vitamin C, and for a lot of stand-up comedians, I was talking to somebody last night, for a lot of stand-up comedians, this is their mantra. And for a lot of us in the competitive analytics world, this is also what we aim to do too, is look at the same set of information and see something and draw conclusions from something that nobody else is drawing, create differentiation through our analysis and interpretation and synthesis of the data. So we're going to use screenshots. There's a lot of competitive intelligence tools that exist out there. There are a number of, you guys have access to a number of them. So when you look at this, we're going to generalize it, but you know, we're going to be talking about just sort of the competitive intelligence applications. And the one thing that we want to look at here, the first thing that we'll talk about very quickly, is just looking at representation patterns. You know, it's a way of looking at the data. A lot of you have seen information like this before. But within the information, how quickly are they changing counsel? Who's getting the work? Who's losing the work? Who's picking up market share? It's fairly basic. We've been talking about this now for 7, 8, 9, 10 years. Scenario planning. To the great delight of many of us who live in places like Oklahoma, Southwest and AirTran are merging. It's going to make travel a lot easier. But it's interesting. When you look at Southwest and AirTran as a combined company, this is what their combined litigation footprint's going to look like. And you compare it against the rest of the passenger air carriers, so the American Airlines, Delta, et cetera, and you dig into the labor and employment side of things, there's a little bit of a growth pattern there with workers' compensation. Low-value stuff for the most part. When you look at AirTran and Southwest, they've got a problem. They've got a little bit of a problem. And while it's not much, we're able to find something that, if we're walking in to discuss this with them, is an engagement point. You know, this is something that we can draw conclusions from, and this is obviously a pain point now that we can engage the client with. Threat assessment. You guys may have heard some things last week. Oric and Aiken Gump were in merger talks that those have since broke off. Another rumor came out through, I think it was in law.com, National Law Journal. Reed Smith and Thompson and Knight down in Texas are also kind of doing the dance on merger talks. But you know, what happens when firms are moving into your neck of the woods? They're coming into your market. How do you react to that? So we actually did this last week for a client. Won't divulge the client, obviously. But most of you now, through the variety of your competitive intelligence tools, are keeping a list of your top 100, top 150 clients. You're keeping that list stored in through there. So the neat thing is the ability to say, okay, XYZ firm is moving into my market, or the combination of the firm. Who do they represent that we also represent? Where is the risk? Where are the threats? So as we look at this list of clients, it's a very distinguished list of clients. We see Bank of America is one that has a lot of work. Well, for the firm that's moving in, just so happens, they do a lot of work for Bank of America, and that's good to know. And we can stop there and say, well, you know what, Bank of America is a risk, but really, how much of a risk is it? As we dig in a little bit further, I want to be able to see how embedded are they. This particular law firm that's moving into our market, they're doing work for Bank of America across a variety of different areas. I'm not going to show you a ton of screenshots, but the other thing that they did, they were doing a lot of patent work, and they were doing some trademark work. I mean, this is an institutional client for this law firm. And that's important to know. The other part of it, they're serving them out of a lot of their offices. So this is not just coming out of one or two offices. This work is spread across essentially their entire universe within the US, just from the litigation side. And my next step in this, by the way, is I'd start combing the press releases and a lot of their recent hires to find out if they've been picking laterals off when they moved into other markets, because we know a couple of things. Not only is our client going to be at risk now, but if this is a firm that has done a lot of work by attracting laterals, we probably have some of our partners at risk as well. And so in 3 minutes, talk about speed, to Tom Stewart's point, in 3 minutes, we can very easily determine the level of risk and the level of threat of somebody entering our market, including which of our partners might also be at risk. And this is something else that I think is pretty interesting as well, too. We hear so often, I think the term bet the business is probably thrown around about in the law firm world about as much as ESPN uses the word great. We hear it so a lot. I think most of us would probably agree that not everything is bet the business that we always hear is bet the business. But it's always interesting to sort of flip it around and see what does the client really value. And this is a company that's based in Georgia. We're keeping a very Georgian theme here. And this is their work, their practice, the litigation where things were taking place in jurisdictions. You see a lot of it. Miami-Dade County, Chicago, Northern District, Southern District of Florida. You go on down to the full list, Cook County, San Francisco County, Alameda County, et cetera. A lot of work. But you look at the law firms that they're hiring in these major metropolitan areas, they're smaller firms. For the most part, roughly 60% of the work, if you add it up, 2 to 15, 16 to 40 solo practitioners, a lot of that work is going to smaller firms. The question is, what type of work is it? And you see that a lot of this work, their total universe here is torts and negligence, commercial litigation, labor and employment. What we want to be able to figure out from that is, of all this work, how much of it and what work is going to these smaller firms? Most of it's torts and negligence. This is something that when the client looks at this, they view this work. And we looked at these firms. These are not smaller boutiques, especially niche boutiques. These are just general firms, smaller firms, major metropolitan areas. This is work that is not considered to be high-value work by the client. They're not going out and hiring the best law firms, the most expensive law firms with the best brand name to represent them in this work. They're looking for the most cost-efficient providers of legal services. And a lot of times we can read through this information, this mountain of data that exists, and find little pockets of information like this that enable better decision making. So we'll get into some insight and now on competitive intelligence, competitive and financial intelligence. A few examples before we actually get into a little bit of a workflow. Cross-selling. I think this is interesting. We always hear this. We're at retreats or whatever it might be. Big meetings with firms, and cross-selling always comes up. I think in every single one of your firms, cross-selling is probably still something that's always brought up. And they'll say, you know what, we're going to take our top 100, top 150, top 200, whatever it is, and we're going to try and cross-sell our services to every single one of them. But then you ask the question, how many actually take the time to look at their clients and figure out which clients have shown the propensity in the past to buy legal services and more than one level of legal services or one round from one law firm? You know, how many of them actually have firms that are representing them in various areas of law? Because if they're not, you probably want to take them off the list and reduce the amount of time you're spending on an opportunity that's probably not going to materialize. And then, of course, the other things you can see on through here that we want to look at as well, too. You know, what fits in with our experience, profitability, which markets, the competitive landscape, et cetera. Client visits. We have a couple of people in this room. I know I saw Sylvia here. I saw Nat here at one point that do phenomenal work around client visits. I think everybody's doing client visits. You know, I think one of the things we want to look at before we even walk into there, no matter who's doing it, is what's our market share? Which other firms are they retaining for similar work? You know, is there potential for picking up any additional work? Does the client typically hire firms, like I mentioned earlier, for more than one area of work? Are they hiring new counsel or replacing existing counsel in certain areas? Is there any risk involved from that, just from looking at what's going on in others, with other providers? Are they sending out RFPs? And then, of course, the bottom part, and this is critically important now. And so what we want to be able to figure out is what are the rates and demand by timekeeper in other markets, by practice area, both existing representation and potential growth areas. And the tools exist, Redwood and Peer Monitor and those types of tools. Hildebrandt's Peer Monitor is a great tool for this, to create peer groups and be able to look at these markets and know ahead of time that, hey, they're using these 7 or 8 firms, and in this market, these 7 or 8 firms for this type of work, this is the collected rate average. And not only that, here's the demand breakdown. The non-equity partners are doing 60% of the work, along with the associates doing 30% of the work. This is, they're operating at a lower cost basis. So now we'll get into the final part here, which is the opportunity assessment and prioritization. Here's our scenario. We have a firm operating is evaluating a couple of potential opportunities. Our firm, Hubbard & Wells, fictional firm. We have 450 attorneys, offices in Chicago where we're based, San Francisco, LA, Dallas, DC, and New York City. We're going to look at 3 opportunities here. We want to see which ones offer the best opportunity for profitability and for success. And it was interesting. I was at a roundtable last week, and we had a CMO roundtable in New York, and we had a lot of CMOs from very large firms there. And one of the questions was asked to the audience members about how many of the firms had a formal go, no-go strategy. And about 75% of the respondents didn't. And these were big firms. These are AmLaw 2550 firms. And there's a gentleman sitting in this audience who will remain nameless, but he's one of the smartest guys I know. And he offered one of the greatest quotes I still use to this day, which was, the test of any strategy is your ability to say no. And I ask that a lot of clients is, what do you say no to? All these RFPs coming in, are we going to just respond to everything? We're just going to go ahead and everyone that comes in, we're going to put all of our time into it. We're going to respond to everything. And we hope not, because as we saw from the survey results, you don't have that much bandwidth. It's just not there. So we're going to use some various things to look at here. We want to know who we know. Obviously, we know relationships drive everything. We want to know what our experiences is, our capabilities. From resource-based strategy to capabilities-based strategy. Our experience. Profitability, obviously, that's kind of what we're looking at. So we're going to look at the landscape of market demand, rates, and realization. We want to be able to look and really understand the competitive landscape, both real and perceived. So the first thing that was brought up was BP. And I was in a number of firms while some of this was going on. You may have heard some of this in the news. BP replaced their CEO. And there was a number of firms that said, our lawyers are coming to us and saying, we need to get involved in this. Well, that's great, but how? Kirkland has had that work locked up for years. Alston & Bird's gotten in with some of the Transocean stuff. That's probably not something that, if we haven't gotten a phone call already, that we're probably not going to get. We don't need to waste time going after it. The next thing that was brought up was picking up some of the ancillary work. If you guys haven't heard, United Airlines and Continental, I think they locked it earlier this week, I believe, and have officially created the Death Star of customer service. I mean, at any point now, I'm expecting Delta to acquire US Air just to trump them and make it worse. But we look at this, and again, you were looking at the firms that are involved. There's no RFPs going out. Mergers always create a great opportunity for a lot of ancillary work, but it's probably not something that we're going to go after. But we got an RFP from a small little company up in Minnesota called Medtronic. They have a new GC, a guy by the name of Cameron Finley. He was hired in 2009. He was a GC at Aon Corporation in Chicago. He was a partner at Sidley from 1993 2001. And one of the first things I thought of is, somebody going from Chicago to Minnesota, is there going to be a similar path as Rick Palmore? And a lot of you in this room who are in marketing know Rick Palmore. He's author of the Call to Action letter. And he was at Sara Lee, and he went to General Mills. And I do a lot of studying because I have no life of this sort of thing. And when he was at Sara Lee, there's certain law firms that he used, and now that he's moved to General Mills, like McDermott, for example, for labor and employment, McDermott's starting to pick up some of that work. So there is that path. Certain people continue to hire the same firms. So the first thing we want to know is, who do we know? And so, one of the things that we'll do is go to our embedded CRM, our embedded ERM, into some of the tools we have, or just flat out to it. Who do we know? In this case, we're pulling the reverse part of it because we know we have somebody in our organization that typically has decision-maker relationships. I blocked those out. But we want to be able to find out, okay, who can really get our foot in the door at the best level possible? What's our experience? At the end of the day, we need to be able to pull this up, pull our database of experience up, and pull this information up. We have a lot of experience through this. And we want to look at Medtronic. We want to look at their footprint. Medtronic, not surprisingly, a lot of stuff in torts and negligence, product liability, litigation, et cetera. A lot of IP as well. But then we want to look at Aon. We want to be able to look, too, at where he was coming from, the universe that Cam Finley was coming from. What did they have? What was he typically used to dealing with? And what's missing from this is IP litigation. And that offers a couple of different, there's some good thoughts in that. One, he hasn't hired firms for that. So there's an opportunity there. We look at Medtronic's existing IP litigation. Not surprisingly, there's a lot of it in the Rocket Docket area of East Texas. I'm still shocked that the Northern District of California doesn't have like a name like the Vino District or the Vino Docket or something like that. But a lot of it's up in the Northern District of California. We have the Eastern District of Texas, some stuff in Delaware. Who have they hired? It's interesting. In San Francisco and in Dallas, they've picked up a couple of firms. McCool Smith is a little boutique down in Dallas. Merchant Gould is a boutique up in Minneapolis, actually an IP boutique. But you look at the firms that they've hired, some pretty familiar names. At the same time, I want to look at Aon. I want to know where this guy came from. I want to be able to see the firms that he used in similar markets because those are going to be competitors. More than likely, we are going to be competing with some of these firms, except for Littler, probably not on the IP litigation side. But DLA is one of them. Baker Botts. Carrington Coleman's a good little boutique down in Dallas as well. You see some of the people just start picking up work. Gordon and Reese is one. So now we're starting to expand our competitive landscape. If we're going to go after this now we're starting to see this competition level and this landscape increase a little bit. In terms of overall work, where did the work go with Aon? Well, not surprisingly, Littler, but with the IP side. But again, there's Sidley Austin. We know Sidley's going to be in the mix. He was a partner there. He's used them quite a bit on a continual basis. There's a solid pattern of representation there. He's going to continue to use them. See other firms that have picked up work recently, a few that have dropped off on work. Ballard Spahr is a good example. They're in red. Picked up work for about 3 years, kind of dropped off. Same thing with Freeborn and Peters. But let's look at comfort levels, and let's look at overall trends. Aon, one of the things that we noticed, a lot of their work went to larger firms. So there's a comfort level with larger firms. He's not typically buying on price. It's good to know. Medtronic, historically, pretty similar. And even the smaller firms they used were boutiques. They were specialists. So we're pulling a lot of information out of here from just what was seen. So we already mentioned the fact that Medtronic's, outside of product liability, one of the greatest needs on a continual basis is IP litigation, something that Aon didn't have. A couple of other things. We look inside the information a lot with Medtronic. They've hired McCool Smith, like I mentioned, for a lot of IP litigation in Dallas. They also retained separately an outstanding firm. It's an Am Law 50 firm based in Dallas for IP transactions. They never got any of the litigation whatsoever. They weren't, and this is a firm with a rock star CMO who has historically had firms that did a great job of cross-selling, and they have not been able to move the needle. We want to look to see the patterns of Aon retaining certain firms in specific markets. So where did they retain Sidley? You know, we mentioned already San Francisco and Dallas and a few other places. Likewise. And then how often are they changing outside counsel? That's one of the things I think is often missed. When we start looking at these opportunities is how often are these companies changing outside counsel? We used to have an example we used with 3M out of Minnesota. And in certain parts of the country, they were changing counsel every 2 years. You would see new representation. And that's got to factor into the decision-making process. At some point, that's got to factor in that, you know what, this is not going to be a long-term engagement. The cost to get this work is not going to be worth what the return is. A couple other things we found out here. Medtronic's primary outside counsel had intermittent patterns of picking up additional areas of work. Medtronic historically was not a great client from a cross-selling perspective, but Aon is. So you have a new GC there, you have somebody new that's coming into that market, has shown the ability or the willingness to buy legal services, more than one set of legal services from any one law firm. That might be something we want to go after now because we can grow this business. The other thing that does, though, is it increases the competitive landscape. So next thing we need to do is we need to look at the financials. We've looked at the experience, it's good. We've looked at our relationships, we're able to get our foot in the door. We've looked at the competitive landscape, we've made the determination based off of that you know something, that is something we want to go after, we think we can grow that work. But now, is it profitable? And so now we start looking at this just from a rate standpoint. And the blended rate between San Francisco and Dallas, and by the way, they are, as you guys know, a little bit different if we were to separate them out, a little bit higher cost out in San Francisco. But the blended rate, equity partner average over the last 12 months, $450. I'm pulling this from one of Hildebrandt's tools that pulls data. This is real information. And pulls it raw from law firm financial systems. There's about 47 different firms that have offices in San Francisco and Dallas that are in this. This is pretty good. This is pretty good information. Non-equity partners at 356 on average, associates at 290, and this is for just IP litigation. But we also want to look at the demand level because, you know, if it gets down to AFAs and gets down to other information, how are we going to set this up? Where is the main driver of work? A lot of this is associate driven, non-equity partner driven, lower cost basis. You know, equity partners, and by the way, you see those 11 to 13 years and 14 to 16 years and things like that. What you're looking at there is the year out of law school, not their age. You know, we look at this, and this is something we want to go after. Rate structure is conducive. Typically, they're operating, and a lot of the work is being done on this from a billable perspective at a lower cost structure, partners, lower cost basis. More profitable. You know, this is something now that as we look at this, I think we want to move forward with this. And you guys have these tools. They exist. Your financial departments have a lot of this information. The tools that exist, you know, with your competitive intelligence tools, this exists. You can do this. You can pull this information out of there. So if someone says, hey, is this an opportunity that we should pursue? Yeah, I think we should. And the other thing is it gives us now is some insight as to how we should construct that team. And now it gets back into what we talked about earlier about the internal sales aspect and the internal politics of things. But now we have a fact basis on which to move forward. with that, because I am in front of everybody for lunch, I think we're good. I'm going to bring Charlie back up. Thank you, everybody.
Very good. So that's an amazing amount of data, and as somebody who loves data, I really appreciate the time it takes to do that. I think part of the problem is that, as we saw in some of the data around your departments and the constraints on it, is that there's not always the amount of time that we have to do stuff like that. I asked Patrick, well, how long did it take to do that? It's about 12 hours of analysis. And notice that he did present the information to meet the hierarchy of needs. It is trusted, but he did the contextualization. He filtered it for this audience, filtered it around BP. He made the connections between the data, and he channeled it. He put it in this presentation, and he delivered it to you. That's a huge inhibitor to you doing that in your firm more than once or twice a week because of the amount of time it takes and the talent it takes to do something like that. So what you're going to see from information providers, not only in the next few days, but in the coming months, is trying to mechanize, trying to use technology to go up the hierarchy stack so that you can get on with what, as my friend Peter Jackson likes to say, you let the machines do what the machines can do, and then you let the humans do what they can do, which is get into the analysis, the insight, and set the plan. You're going to be hearing a lot of this in the coming months, and it's going to be a real benefit to your firm because we're going to take away all that time in the future and connect that information so that you can get on and help your firm with some of these resource allocation decisions. Thanks a lot.